done the introduction on my. Okay. So when it comes to just overall wealth management, just like when you're planning for your investments, you're just planning for your life in general, it's so, so important to have the end in mind. How can you picture your ideal life? Is it now a happy and healthy family? Do you love to travel, to retire in your life in your own terms? Because you have to remember, for you to be able to live the life that you want to live, your ideal life, you have to be able to manage your money. So the question is, what does money management look like? What exactly does it entail? Because for the longest time, the reason why we're even having this webinar is because when people think of money management, the one thing they think about is just the wealth creation and the investments, something that I'm sure that you know very well, because this is something that Agatha keeps on talking about over and over again. And I've even had some people asking about bonds, yeah, because it's still in that space of how do I grow and multiply my money? So there's three pillars of wealth management. I want you to put this down, and I hope you all have a pen and paper, because there's not going to be so much in the slides. So I'm going to be doing most of the talking. So I hope you have somewhere to note it down. So there's three main pillars of wealth management. When you think of ninapanga pesa yangu, there's three main ways. Number one, the one which, as I said, you're very conversant with, is wealth creation. This is something that Kenyans love a lot. This is why you hear people are like, okay, let me buy a piece of land. Let me go and invest in bonds. Let me invest in the stock market. Yeah. So I want us to look at this. Just always remember this, no matter what. Wealth creation. Now, when it comes to the three pillars of wealth management, yeah, I'll take you bit by bit, but first of all is wealth creation. So just remember, wealth creation is your investment portfolio, because what your investment portfolio does is to promise you that you're going to take a specific level of risk for a return. So this is now to grow and multiply your wealth. And when we talk about investment portfolio, as we'll go ahead, this, as I said, consists of the bonds, because remember, you're putting money in the bond. As Agatha said, yes, you're loaning money to the government, but you're expecting a certain coupon every 6 months, and then at the end of the day you get the amount of money you put in. Yeah, and then also the same thing when it comes to putting money in the stock market. You buy shares because you're expecting dividend or the share value to go up, because that means it's still under wealth creation, the growing and multiplication of wealth. When you even start a business, you start a business because you expect to make money from it. You expect some level of cash flow, and you expect that, okay, this business is going to grow over a period of time. So anytime you think of your first pillar of wealth creation, just remember that those are your investments. This is why now you've also seen people putting their money in crypto and forex. Yes, those are people who've taken a very big risk, and sometimes the money comes, sometimes it does not. Yeah, so that is where now your investment portfolio comes in. So let's go to a very common scenario in Kenya. I'm sure you know somebody who knows somebody, or it could even have just been you, right? So you are in the process of growing and, multiplying this world. So you're saving and you're investing, because this is something that you really are excited about. We are all excited to hear of, okay, there's a piece of land that has come up. They are close to the road. Let me go and buy it. Oh, I've had the Safaricom shares are out. Let me go buy. Oh, there's a bond that has just been floated. Let me buy. Yeah. So you cut corners and you save some money, and you don't have a protection plan or a liquidity plan. Yeah. Because all you're focusing on is growing of this money, and then now life happens. Yeah. Because one thing you have to remember is life is extremely seasonal. There's times that are going to be good, and there are times which are not so good. Yeah, because nobody ever wakes up thinking that they're going to fall sick. Nobody wakes up and thinks that a family member will pass away or get a disability or get a cancer or a stroke, but it does happen. Yeah. So when it comes to overall like protection, most people think of an emergency fund. So you have to remember that, okay, you've put aside an amount of money. Maybe it can take care of 6 months worth of your overall home expenses. But then now, because it's a very big emergency, even your emergency fund is depleted. Yeah. So what happens? So when your emergency fund is depleted and you're in a place that you're in dire need, you have to now either now sell your assets. So all these assets that you've been accumulating, you have to figure out, how can I sell them? Secondly, you can be like, okay, I can try and get a loan, yeah, to maybe take care of this illness or this situation that I'm at that is unexpected. Or another way that people do is now where Harambe comes in, because you have to remember that, yes, you're putting all this money into your investments, the savings, because they're usually a bit temporary, are finished, and then now the investments are not as liquid as you expect. When you have that shamba, even if it's in a prime area, you know the time limit and the process to actually sell. It's very long, and something like an illness requires help right now. You need to go to the hospital now. So you have to figure out, where am I going to get this money? Yeah. So just like that, all the savings and all your investments are gone, just like that. Like literally, the savings and investments that you've been growing for like the last 10 years just disappear. So it means that your get rich plan is actually screwed, because now everything that you've been doing has disappeared. So you have to start from scratch, saving and investing again. So this takes you years and years back, stealing all the time and freedom, because you have to remember, why do we even invest? Why do we even know why we even this wealth journey? Is because we want to live a certain type of lifestyle. And by us putting this money aside, it means that it has bought us time, especially now maybe you have some sort of cash flow, but now if you have to sell all your assets, you no longer have cash flow and you have to start afresh. Yeah. So what are the factors? It's very important, even as you're thinking of your ideal life, you're thinking of all the assets you have. Like right now, I want you to start thinking of, okay, what are the things that I have currently? What have I bought as an asset? What are these factors that threaten the growth of your wealth and your ideal lifestyle? That's a very important question to ask, because majority of the time we think about, oh, I want to grow my money. Oh, I need to invest here. But the one thing we don't like to think about, I think that's why us in the insurance field are not very popular, is because we are forced sometimes to think, okay, we have this laid out plan, yeah, but what could possibly go wrong? Yeah, because we understand sometimes we do things and we're like, okay, I'm planning to go to Westlands. And then you're like, okay, it's going to take me about 20 minutes. But then you get traffic or there's an accident. So the 20 minutes you had anticipated ends up being 1 hour. So it's very important that now, okay, you know that this could happen. So maybe now you have to leave earlier. Same thing now with your wealth journey. You have to ask yourself, now I'm here, I'm making my money, I'm putting my money in bonds, the stock markets. Yeah, I'm buying this land. Yeah. So what could actually go wrong and affect my overall wealth and lifestyle? But first, the most important thing to establish, who is the greatest assets? Because usually when we count our assets, we put now all the different things that we've actually bought. But remember, you are your greatest assets, because if you are not there, it means that even the assets that you buy, all these shares, the stock markets, the bonds, it will not be possible, because you are the one who actually provides that income. You work, you make that money, and you use that money to buy these assets. Yeah. So yeah, that is the most important thing to establish. You are the greatest asset. So these are very important questions to ask yourself. Yeah. As I said, I want you to put it down, so that now you can introspect, do some bit of introspection, especially when you're planning your wealth this year. It's a perfect time that we're doing this webinar. So number one, here are the important questions you ask yourself. What can happen to me? Yeah. Like let's say for me, Mnindo right now, all those who are close to me, my family, my friends, that can affect my lifestyle. Yeah. I currently maybe love to travel once a year. I love to eat in specific places, live in a certain area, neighborhood. So what could actually affect that lifestyle? What will make me have to move and shift from maybe the place I'm living in now and maybe to a place that maybe is a bit cheaper because now something has happened? Okay, number two, what can happen to me that affects my existing savings and investments? You're currently in that wealth journey. So what is that thing that could happen that could now lower down that pot? Yeah. And thirdly, what could happen to me and that could affect my ability to make an income. Because remember, we have established that you are your greatest asset. So if your income stops, even these assets are going to be affected. So you have to be able to answer these questions so that now we can be able to properly build your protection plan. So these are what we call personal risks, whatever it is that you have answered, because everything that you have answered there is pertaining to you. Yeah, you as a person. It's not your car, it's not your house. What are the things that could happen to you that could affect all these things? So that is what we call a personal risk. And these include, number one, an illness or an accident of yourself or a family member. If that is to happen, obviously you have to contribute, or you have to put this money aside to ensure that they're well, or even yourself as well. In the case of a disability, you got into an accident and now you're paralyzed, you cannot work anymore, or you get a critical illness. We see these things a lot on Instagram, or even our WhatsApp group. You hear someone has gotten a cancer, a stroke, a heart attack, so they can no longer go to work. Number three, unexpected and sudden death of a breadwinner or someone who is providing an income for the household. Yeah, that could really shift the dynamics of your lifestyle or your overall wealth plan. So there's the other risk of maybe living too long without money or resources to cater for old age. The small unexpected emergencies like a car breakdown, loss of income due to now you have been retrenched, so you are now unemployed. And also, a very big risk is inability to provide for yourself due to lack of proper planning. That's also a personal risk. Yeah. So what are the solutions to personal risks? So remember, we've asked ourselves what could possibly go wrong. Yeah, life, we understand, is not a straight line. So even just as you're driving your car, no matter how much faith it is that you have in your driving skills, you still have to put on a seatbelt, because we all know that life does happen. So what is the solution to a personal risk? Because when life happens right now, if life was to happen and issues to hit the fan, what we need is cash. We need liquidity. Yeah. So having liquidity that can take care of unforeseen circumstances is the solution to a personal risk, or just risk in general. This is where now your protection portfolio comes in, because a protection portfolio is meant to give instant liquidity in the case of the unforeseen. As we have mentioned, all these assets, in as much as they're helping us grow and multiply our wealth, they are not going to give us access to immediate money in the case I was sick. In the case you're sick, you cannot go to the hospital and tell the doctor, by the way, I have a prime plot there in Karen. Please, can I go into the clinic, or can I be able to buy a bandage with that prime property? People are like, I want cash, I want money. Yeah. So what a protection portfolio is meant to do is actually provide that money that you did not have to be able to take care of a risk like this. So a protection portfolio is a combination of your emergency fund, which I know Agatha has spoken over and over again, and I even know that there's a challenge currently going on. But you have to understand there's some risks that even an emergency fund cannot take care of. You know that if you're to go in and be in the hospital and get admitted, your emergency fund literally can go in a few days. So now, if the emergency fund is not enough, you have to have a second layer of protection, which is your insurance. So how insurance works is all of us face the same risk. And right now, because we're talking about life insurance, we understand that we all face the same risk of maybe someone dying prematurely when their family is still depending on them, or getting a cancer, stroke, unforeseen illness, or even get a disability. The only question is, who? We just don't know who, but we know because the world is as it is, there's someone who will be affected. So what we do is we all put together this money, like we all contribute the bit it is that we can, so that in the case, if it is my family will be paid out. Yeah. If it was your family, we know that your family will be taken care of with all these contributions you've done. So always remember that an insurance is like an inverse Harambe. So remember, with Harambe, the thing happens, someone passes away or someone gets sick, and then we now run around trying to contribute. But insurance, because we know it's going to happen, we just don't know who, we're like, okay, let's just put this money already so that it's existing in a pot, yeah, so that when it happens, whoever it is has been affected has immediate access. So always remember, protection portfolio is immediate access to cash in the case of an emergency and foreseen circumstance. So let's continue. That takes us to the second pillar of wealth, which is wealth protection. So we've created our wealth. We are creating our wealth. We are making our money. Life is going great. But then we have to now cover it. Think about it as a fence around all the wealth it is that you're creating, because there's enemies that face your money. Yeah, there's things that will come to come and destroy what it is that you've tried to create. Things like a disease that is unforeseen, someone passing away prematurely that you did not see coming. All these things, okay, you lost your job. These things do happen. So we have to make sure that we have a protection strategy around our wealth creation. Yeah. So wealth protection is now your insurance portfolio, which is meant to protect your wealth. Remember at the beginning we said wealth creation is investment portfolio, which grows and multiplies your wealth. Here we have wealth protection, which is now your insurance portfolio, which protects your wealth. So one part of the insurance portfolio, one very critical tool is what we call life insurance. And that is what we are here to talk about today. So what is life insurance? Because for the longest time, just by me being in the market, most people, when you talk to most people, they put life insurance in the same category as a piece of land. They put life insurance in the same category as the stock market. This is where you hear people are like, lakini this life insurance, it does not give me a good return on investment. But you have to remember, life insurance is not meant to give you a return on investment. It's meant to shield you. It's meant to shield your family in the case life was to happen. So what exactly is life insurance? Yeah. So life insurance is a financial tool that leaves lumps of cash to those who depend on you when you pass on. Yeah. So what it means is that remember, you are someone who's a provider. For any parent who is here, or someone who's expecting to be a parent, there's a specific amount of money that you're contributing to the house. The moment you are no longer there, that income stops. Yeah. So what is that thing that can replace your economic value? So what economic value is all the money you could have made in your lifetime. So if you are no longer there, obviously you can no longer make this money in your lifetime. So you can imagine right now the space you're at, especially if you are between the age of 25 to 50, we are in what we call our wealth accumulation stage. So right now we are collecting assets. We are over here trying to focus on our investments. But you have to remember that if anything is to happen in between, yeah, we're to get that to traffic as we're going to Westlands. If someone is to now like pass away, yeah, or get a disability or critical illness, it will kind of halt our wealth journey, our creation journey, because number one, we will have to access that money that we did not see, that we have to access the money that it is we've been saving and investing. And number two, if we don't have that money, it means we have to take a loan. Yeah. So all the money it is that we've been trying to build is going to be shattered. So always remember that life insurance, it provides an instant lump sum in the case someone was to pass away, so that the people who are depending on you to continue living the life that they're used to. And also to give them that transition with dignity. Because I'm sure that you have seen people who've passed away and their families' lives go from 100 to 0, like in a matter of maybe even weeks. It's said that when a breadwinner dies, it's only a matter of a month that the family is actually affected. The schools the children go to, they can no longer pay the school fees. The place that they live, they can no longer pay the rent. The food, clothes, shelter, things that are so important can no longer be given because someone's income is gone, and because maybe their investments are locked down in an asset like a piece of land. You can't expect a 6-year-old to go and sell a piece of land to be able to take care of the bills. And you also have to remember that succession in this country can even take 5 years. So you can imagine, even if you have all those assets, if you do not have like a tool that is going to give your family instant liquidity, they might not even have money for a lawyer to be able to take care of that thing. So just always remember, life insurance is to give instant liquidity in the case of a death, but it also has living benefits. Because sometimes someone might not die prematurely, yeah, but they could get a disability, which will also affect the income, or a critical illness, yeah. So as I said, when I say critical illnesses, the serious illnesses, not like the malarias. The malarias, someone can just choose a medical cover, but there's the illnesses that now you are in hospital for an extended period of time. Maybe you are in a coma, you get a cancer, you have to travel out of the country. Where's the money going to come from if you didn't have a liquidity plan? Yeah. So why should you get a life insurance? So number one, yeah, life insurance policies do not go through probate courts when one dies. So the payout cannot be contested. I'm sure you've heard the drama that happens with African families, especially with relatives, when someone passes away. People try to contest. They're like, no, this piece of land, it was actually not belonging to that person. It's not belonging to him. We should actually divide it. So you see now, when you have a life policy, as long as you've put a beneficiary there, nobody can go to court and say, hey, by the way, even for me, I was depending on this person's money. I need you to put it there. Yeah. And also another thing, remember, with probate courts, you're giving a judge, someone who's a stranger, the power, to decide what is to go to your family. Yeah. That is actually a very tough place to be. Actually, talking from experience, it's a place that you do not ever want your family to be. Because remember, if someone has lost a family member, a loved one, they're going through grief, they're going through pain. Now you can imagine you're going through grief and pain, and then now you have to deal with money issues. Yeah. And secondly, life insurance, especially now when you get a good one, that's why it's important to also look into which company you get this insurance with. Always look for a company which has at least a 99% claim settlement ratio. So you know for sure this claim will be settled. So payout is usually down in about 2 weeks, less than 14 days after claim is made due to a death or diagnosis of a critical illness or total and permanent disability from an accident. So in the case of someone getting a cancer, like you can imagine what usually currently happens. Someone gets a cancer. Now maybe I want to go through it by myself. Yeah, I only want to let my family members know, my close family members. But now because I don't have money, I have to tell everybody, because I have to actually put up a poster so that I can tell everybody, well, hey, I'm not feeling well, I'm sick, and I need to go to India. Yeah. So at least, because even for me, I have worked with clients who have claimed critical illness cover. So they've been able to go through an illness with dignity. You didn't have to send any WhatsApp messages. You didn't have to ask people money for anything. Because I've seen these WhatsApp groups, and the one thing I feel is that it erodes someone of their dignity. Because there's one which I saw, someone was asking, please put a breakdown and account for the money we just contributed. Imagine, with someone who's not well. Yeah. Number 3, payout is tax-free. So the amount of money that people receive with a life insurance, your family will eventually receive, is not going to be taxed. And then number 4, it ensures that your family does not have stress or is not desperate to liquidate any investments. Because remember, you're making investments so that your family can also benefit from it. Because I'd like to believe, if we are here and we have family members, life is not just about ourselves. Yeah. We also have to be responsible human beings and ensure that, okay, I have a family member, and if life is to happen, because nobody knows how things can go, at least I know my people will not have to liquidate any investments prematurely. I know people who've had to even sell like very prime property at a throwaway price because someone was sick. So you can imagine, you've just robbed your children out of an inheritance due to a sickness. I want you to feel the pain of having to use your own investment to service negativity. It is not your portion. This is why insurance exists, so that you do not have to ever go through that. And number 5, it ensures continuity in the family unit so that people can actually focus on healing. So if you're someone who's ever gone through a tough time, like someone passing away or going through a sickness, you can understand how stressful and hectic it is. So you can imagine, first of all, the person who's going through it is going through stress. The people around them also going through stress, because they're like, why our friend or our loved one is not feeling well. Now we have to figure out, how are we going to look for the money? So I always say it's important to have a protection plan so that we can allow our friends to show up in different ways. Sometimes our friends would actually want to show up, but maybe they've just lost their job, or maybe now they're taking care of the household. They don't even have any extra money. I'm sure that you've been at a place where you wanted to help someone, but you can't. You just don't have the cash. So you can imagine, if all of us had some level of protection, at least it will come through. Yeah. So that is a very important reason on why a life cover is very important, especially if you are in your wealth creation journey. You do not want to miss out in a protection plan. Anything you love, anything you care about, you have to protect. And you have to remember the reason why you're making and creating and multiplying your wealth is for you to live, you and your family to live a specific lifestyle, a comfortable lifestyle of peace, love, and joy. But these things can get disrupted without a plan. So these are very important terms to know as you're moving forward. And I'm going to just give a few. I'm not be able to do everything because Agatha's given me a time limit. So I need to make sure that I do this pretty fast. So number one, we have premium. So premium is that amount of money that all of us who are taking an insurance policy contribute, the small amount. Have you ever asked yourself, okay, I'm paying 5,000 towards my policy to get a 10 million shilling cover? Have you ever asked yourself why that works? It's because us as a unit, us collectively, us as a society, we know that life will happen. So we are contributing these premiums. I rather sacrifice that 100 that I can plan for compared to like 10,000 that I can't plan for. Just the way like with medical, I rather put aside 30,000 that I can plan for every year compared to an unexpected 2 million because you had to get admitted. Same thing with life cover. I rather put this 5,000 or 10,000 every month so that in the case I was to pass away or get a critical illness or get a disability, my family will get that 10 million lump sum. Yeah. So let's go to the sum assured. Sum assured is the actual benefit the family will get in the case of a death, disability, or critical illness. So in the case of a death, the people who get it is definitely the family members because obviously you are not there. But when it comes to critical illness or disability, you are the one who's going to receive that money, and that money is going to help you at least figure out your life and replace your income in the time being. Grace period. If you've ever taken out a life policy, remember life policy is very long term. Yeah. So every month you're contributing. But let's say, for example, you've lost your job and you can no longer pay. There's what we call grace period, which varies from 30 days to 90 days, depending on the insurer, where you're going to still be in cover, even if you've not paid the premiums. So let me give you an example. Let's say I've been paying premiums for like the last 3 years, and then I lost my job today. Yeah. And in month 2, someone actually passes away. So because let's say, for example, the insurance cover I had a grace period of 90 days, it means my family will still receive the sum assured, but the only amount of money that will be subtracted is the premiums that were not paid for those 2 months. Yeah. So so it's good to look for also an insurance that has a very long grace period. Term of covers, how long are you going to pay for this cover? How long do you need this protection for? Yeah. Cash value. If you're someone who's ever put money in an endowment or an education policy, because it's a combination of a life cover, yeah, the one that takes care of you in the case of a death, disability, or critical illness, plus an investment or a savings, it means that in the case now it's 3 years have passed and you want some of your money back, there's a cash value that it has collected because of the investment element. Yeah. So someone sometimes after a certain period of time can access it. Obviously, though, it's much less than sometimes what you've put in. We'll talk about that. Yeah. Something to know also is wave of premium. So this means that, let's say, for example, someone was to get maybe an illness, a critical illness, or a disability, and the payout is done, all the premiums moving forward are going to be wiped out by the insurance company. Yeah, it means that you no longer have to pay the premiums, but the benefit will still be paid. A rider is an additional benefit to a life policy. So usually something like critical illness is a rider, a disability cover is a rider. So these are just now like the add-ons. Yeah, it's like now you buy something and then like the things that to like now just add to it or beautify it. Yeah. So how much cover is enough? How much cover is actually enough to take care of you or your family in the case of a death, disability, or critical illness? Because the one thing I've noticed is so many of us are actually extremely underinsured. It means that whatever it is that we have as a sum assured is not going to be enough in the case of a death, disability, or critical illness. It can actually not replace our income. Yeah. So number one is what we call the multiple method. Yeah, this is usually the easiest way of calculating how much life insurance you actually need. So this is a multiple of your annual premium. This is best if you don't have any debt, if your life is pretty straightforward, you don't have like a mortgage, you don't have like huge debt, you can just calculate a very simple level of cover. So life cover, usually the rule of thumb is 10 times your annual income. So I gave an example here. If my monthly salary is 100,000 shillings, yeah. So my annual salary is 12,000. Let's assume this is my net salary, yeah, after tax, yeah. So every year I receive 1.2 million. That's the cash that actually hits my account after the taxes have been removed. So the life insurance that we need to replace my income by rule of thumb is 12 million, because it's 1.2 million times 10. So at least I know if I put this, if there's this 12 million and God forbid I was not there, and I have young children who depend on me for education, for their upkeep, for their housing, if this 12 million was even to be put in a low risk investment, the ones that Agatha talks about, let's say even if it was even to be put in a money market, it means that at 10%, that's receiving about 1.2 million shillings a year. That means it's 100,000 a month. You've seen how it's worked backwards? Yeah. So it's important to have this number right. But I always say, let this number not intimidate you. You can start with what it is that you have as you build to the ideal life insurance need. Yeah. The second one is what we call the capital needs method. So based on how much money you will need to cover any expenses or debt upon death or total and permanent disability, you have to calculate an actual number. Because remember, if we were to use this method of the multiple method, and you have a loan of 6 million, so it means that when you pass away, maybe the 6 million will go towards the loan, and maybe the other remaining 6 million will not really be enough for your family. Yeah. So if you have a very big loan, yeah, it's important to put that into consideration, because when you pass away, money has to be, imagine even if you pass away, you still have to pay someone's loan. Can you believe it? Yeah, you don't die with the loan. You still have, it still has to come from your estate. So if you don't have it, they'll look for your people. Yeah. So if you have a loan, ensure that you've protected that loan. Yeah. So how do you calculate the capital needs method? So don't worry, there's the free ebook that you're going to share. So it has all this, so that now you can be able to calculate what is your actual need. Yeah, there's a life insurance calculator, because it's important, number one, to look out for the amount required to clear existing loans. So please go sit down and check your loans, especially the bigger loans, the long-term goals, and then how much is required for your family's regular expenses. Okay, is it that they spend about now like 80,000 a month? It's good. Okay, how much do you need for your children's higher education? So that you can also include their education, just in case something is to happen to you, your children's education can still be taken care of by this policy. So usually we add like an extra 10% for miscellaneous and also inflation. Yeah, just in case. Because now we could be working with like the 12 million before, but remember 12 million today will not be 12 million in like 5 years. So it's sometimes just to give room for inflation, we add that. But don't worry. And then now it's important to subtract. Okay, do you already have existing policies? What is the sum assured of your existing policies? If you have a group life, yeah, what is the sum assured? I know some of you have never even gone to your employer to check what is your benefit. So it's also very important to make sure you know, okay, if I was to pass away today, my family can actually get this amount from the group life. I know not everybody has a group life cover at work, but if you have group life, please go back to your HR or the person who's in charge of your benefits and ask, please, can I know what is my group life amount? And please don't confuse group life with maybe WIBA. Yeah, WIBA is now the compulsory benefit that is given, but it only protects against accidents. Yeah. So you have to ask, okay, do I actually have a group life or is it group accident? Please go and ask and clarify. Yeah. And in the case, maybe you don't understand, we also offer that service. We can always guide you. Yeah. If there's already existing college funds from your investments, other savings, you add them all here. And then eventually you subtract the need minus what it is that you have. So you can see the net life insurance requirement. But please, you're going to do this by yourself. You'll get the ebook by the end of this session. Yeah. Okay, I want you to do an exercise briefly. based on how much the sum assured you have now. For those people who have policies, if you don't have, remember your sum assured is zero. Yeah. But if you have a sum assured, you have a life policy right now, I want you to put down what is the life policy. Is it 2 million? Is it 1 million? Is it 3 million? How long can your family actually survive on it in the case of a death? Like, even with death, I always say, like right now, imagine, yeah, you're to travel to a far country, never to come back. Who is that person who's going to be most affected? Who's that person going to be affected when it comes to now just your overall presence? And secondly, the income it is that you provide, if you're never to give that money ever again. So you have to ask yourself, I have an endowment policy or an education policy, and the life assured is, let's say, 1.2 million. How long, realistically speaking, can 1.2 million take my kids if I was to pass today? Yeah, because this is now the time when people now have to downgrade schools. They used to go to an academy, now they have to go to a primary school. Yeah, because they couldn't afford. This is when now someone has to move houses. So this is another extra layer of trauma to the family just because there was no plan. So you have to, number two, check how much critical illness cover do I have? In the case right now is diagnosed. And remember, critical illness cover is no medical cover. Medical cover pays hospital bills. Critical illness cover pays a lump sum. Anything under life insurance, remember, it pays out cash, a lump sum to replace your income. So even critical illness, if right now you are diagnosed with a cancer, maybe it will be important for you to actually rest and focus on your healing. You don't want to go and start working till the very end. I feel like majority of people pass away because there isn't enough money and there's stress. Actually, it's usually money stress, because at that time now, this is when now you're trying to accumulate funds. Yeah. And in the case of a disability, because there are people who get a disability through an accident or to an illness, there are people you've had maybe got a stroke and now they can no longer move. How much is the sum assured? If you've never done it, please go and check it out, because this is very important, even as now you plan to take up a life cover. Yeah. So let's go to the different types of life cover. There's different types of life cover. I'm going to go through it pretty quickly. And if you have any questions or need further clarification, you can always go back to our page at Le Risk Africa, or you can also now DM us or send us an email. Right? So number one is what we call term life insurance. It's the vanilla of all insurances. It's like the basic. So this provides protection for a finite period of time. It could be 10 years, 15 years, 20 years. And it offers death benefits or the critical illness or disability only during the term. So the one argument has been is, let me put it this way, yeah? So with term life, just think about, okay, how does medical insurance work? How does motor insurance work? So with motor insurance, you take a cover for about a year. So if something happens within that year, yeah, there's an accident, your car is stolen, there's going to be a payout by the insurance company. Yeah, that year. If nothing has happened, yeah, we are going to thank God that nothing bad happened to you, no theft, but you don't receive your premium at the end of the year. Yeah, I don't know. There's some people who maybe are trying out to see if they can have like cash back, but usually with most, like the basic term life, you don't get something at the end of the year. But you see, now you have to remember, this is a risk management tool. You're like, okay, my children right now are 2 years old and 3. Let me give myself as an example. I have a 3-year-old and a 4-year-old, and they're going to be dependent on me until approximately the age of 25. When now they're done with high school, done with university, and hopefully they are working, they're making their own income. So there are people who are like, okay, right now I'm in my wealth accumulation stage. I'm bringing an income home and I'm doing my savings and investments. If something happens to me at, let's say, year 10, yeah, let's say now I'm looking into my children, moving from my house, or like being independent at the age of 25, yeah. But if something happens to me in between, somewhere in between there, my children will be drastically affected. Now, that is where now a life insurance has to go hand in hand with your wealth accumulation. Yes, on this side, you're accumulating your wealth. On this other side, you're protecting your wealth. So that in the case something is to happen in between, their life cover comes in to fill in that gap. Because the reason why we take an insurance cover is because we don't know when and how something will happen and if it will happen during that period. So when it comes to term life, same thing. So let me give you a very good example of term life insurance and how it's usually used. Yeah. Because it's the cheapest of all life covers, but it's not popular because sometimes people don't get money at the end. But there's some policies which actually do offer your premiums back in the case you've not used it, you've not used your life cover. Let's say you're like, okay, I'm protecting my wealth for the next 16 years when my children are very vulnerable. Yeah. So if something happens within the 16 years, there's a payout. Generally, if nothing happens at the end of the 16 years, well, we thank God you're still alive. Yeah, your goal, the money it is that you've accumulated has already accumulated. You do not need any protection at that time. So number one, mortgage protection. If you're to get a mortgage today, your bank is going to insist on you having what you call mortgage protection or mortgage insurance. What that means is, yes, I'm going to pay for this house for the next 20 years. But if life is to happen, because remember, I'm paying that for the house from my income. Yeah. So the bank keeps on taking from my income every single month to pay for this house. But if life is to happen and you pass away, say in year 5, yeah, if you don't have any sort of protection, yeah, it means that the bank can repossess your house and your family will have no place to stay. So that's why you get a term life of the specific period that you're going to pay that mortgage for. Yeah. You're like, okay, I'm paying the mortgage for 20 years. I'll take a mortgage insurance for 20 years. So if something happens within the 20 years, a death or a disability, the life insurance will kick in, pay the bank, and then my family will stay with the house. Yeah. If nothing happens, it means that I already have my house. I've finished paying the mortgage. I don't need any protection at that point. Yeah. Same thing for loan protection. That's why I said if you have a loan and you know the loan is for a specific period of time, you can take a term life for that period of time. Yeah. It's not because term life is the cheapest way to protect now that eventuality for that period. And also education. So how I always say is that I am already saving up and investing towards my kids' education through mutual funds and through the stock market. But if something is to happen, remember that if I'm to even put money right now and something's to happen in between, it means there's no more income coming in to be able to accumulate that money. But if I had a life cover, even that term life cover that's protecting my children's education for those 16 years, it will come into the education pot. Yeah, that's how I do my education planning. There are people who do it differently, but for me, I am doing my investments because I know when I do this accumulation through now the stock market or mutual funds, my money will grow. But I also need to ensure that that fund is protected, because that's why I say, like, for people who just save for their kids' education using money market, you have to remember, if you're to put 10,000 today in money markets every single month for 1 year, at the end of the year, that will be 120,000. If you pass away, that 120,000 will still be 120,000, maybe with some change, with some interest. Yeah. But if it was life insurance, yeah, it means that if I was contributing like a bit of amount of money towards a life insurance, it means if I was to pass away in 1 year, the insurance has to pay, whether it's the whole 10 million, the whole 5 million, it doesn't matter. Whatever it is that I took as cover, just always remember your car. If you to take a motor insurance today and to get a write-off in the next week, the insurance has to pay the whole amount, because we didn't foresee it coming. We didn't see the accident happening, but it did happen. So insurance says it doesn't matter when, you have to pay. Yeah. So this is an example of a term life cover, because most people think it's so expensive. But you see, for a 10 million shilling cover for Anne, who is 30 years, for her to protect this, let's say, for example, she's in a wealth accumulation stage. She just wants to protect maybe her loan for 20 years. She just wants to protect maybe the funds that she's saving for her kids' education for just 20 years. She only has to pay 5,500 shillings. So you can imagine, if it's a 5 million shilling cover, it's like 2K. Yeah. So it's extremely, extremely affordable. So what that means is, in the case she was to pass away today due to natural causes, the family will receive 10 million shillings. If she was to get a critical illness, because as I said, sometimes not people don't die, but they get a sickness. So in the case of a cancer, heart attack, so always check what your insurer is covering. Heart attack, open heart surgery, stroke, paraplegia, coma, kidney failure, These are the things we mostly see people usually ask for their pills. Yeah. But if she was to be diagnosed by any of this, the insurer will give her 5 million shillings cash to take care of that illness. Yeah. In the case of a total and permanent disability, she will get the 10 million as well as an income replacement. Always remember these are income replacement tools. In the case of an accidental death, usually they'll pay double. Yeah. So if she had a 10 million shilling cover, if she was to die due to an accident, something exploded, she was in a car accident, just with 5,000 shillings, it will pay 20 million. Yeah. So that is an example. So the second type of life cover is what we call whole life insurance. So remember, with term life insurance, it's for us.
Hi, Marianne. Please allow me to stop
Hi.
you there.
Yes.
Allow me to stop you there because it's been, you're already halfway through your presentation. And because we want it to be a very interactive, webinar, also to give you a chance to sip some water, it's important for me to maybe ask you 2 or 3 questions, right? I'll just ask you 2 or 3 questions that people have submitted.
Yeah.
Then you can leave your presentation. But I am also I'm asking people who are in this webinar, are you learning? Are you learning? Tell me, are you learning? Because for me, I feel like Marianne is explaining. So Victoria says, yes, she's learning. Please tell me if you're learning, because it's very important for us to do what we came to do here. Yay, Greg, thank you. Thank you, Kanja. So people are learning. So, Haya, I'm very happy to hear that. I like the fact that Marianne is explaining insurance in peaceful. Why do I hear an echo of myself? But back. So Marianne, somebody commented, Musa says it appears that life insurance is more important than your response to that.
They're all very important. Yeah. It's important for you to do both, because remember, if I do just protection for the next 20 years, what will I eat if I was not putting money in an investment? So it's good maybe now, as we said, to put it in order of importance. Like, let's say when you're starting to build your financial house, start with the protection. That's why we always say start with your emergency fund. Please don't start investing if you don't have like some a plan just in case life was to happen. Same thing. Yeah. You start with your foundation. Foundation is your protection plan. So they are both very important, because you don't want at the end of that 20, 30 years, you've only protected, but you've not grown your money. Because I've realized people are usually either or. They're extremely risk averse and have like protection policies on protection policies on protection policies. And there's others who just do investment. So it's good to have a combination of both, because they're all very important pillars of our wealth plan.
Okay, yes. So that is why I keep insisting on the wealth tribe. Before you DM me to ask me, when can I buy a bond? When can I start investing in the stock market? When can I buy treasury bills? The first question, just like Marianne, is, do you have an emergency fund? Do you? If you have, go back and start.
It's important.
Yeah, yes. So, and then the other question somebody is asking is, what is the basic? I don't know why I'm hearing an echo of myself. Are you guys?
I'm also hearing an echo. I'm hearing an echo.
I wonder why. But what is the minimum private medical insurance cover?
I didn't hear that. Sorry, please repeat that.
What is the basic bare minimum private medical insurance cover?
Okay. So when you're planning your protection, number one, please make sure you have NHIF. That one is the public one. So when it comes to private, start with a very good inpatient. Yeah. A basic, I've seen medical policies of even to a minimum of like $1 million for like 6K. Like, it's just like literally there's actually 500,000 for 6,000 a year, depending on your age, obviously. So the basic bare minimum private medical cover start with a good inpatient, because the thing that can actually pay like make you get stuck is admissions. You know, like me going to a doctor, like a gyna, going like for a checkup right now, I can ask a friend for like 2K.
Yes.
But when you're admitted and you need 400,000, now that means now you have to start a WhatsApp group or an appeal on Instagram or WhatsApp. Yeah. So basic, please just have a good inpatient.
Okay.
NHIF, then a good inpatient. You are saving on cash. Then after that, you can layer it.
And please, Marianne, comment on the fact that NHIF works, because people seem to be very
It does. Oh my God, guys, please. NHIF actually works. I can attest to it because it's helped me and it's taken care of a bill of mine. There's a time I was in hospital for about a month. It actually did pay. Yeah. So and it was, please contribute towards your NHIF. No matter what you feel about the government, please just, it's important. Yeah. And there's some things that can only be paid with NHIF, especially your bed up to 4,000 shillings. So even if you have private medical, you will be given a bill if you are not paying an NHIF because it's rebate. Yeah. So it means that it's compulsory. Yeah.
Thank you. I wanted you to comment on that because I remember the first time I consulted you about my own private medical insurance because I'm self-employed. You told me there's no way that I can have HIF. So it's good that
yes, yeah. Yeah, it's important.
Okay, one last question before I give you an opportunity to continue is Jeremiah asked, in terms of insurance, do you need to get life insurance separate from the insurance provided by your employer? Will that result to double insurance?
Okay, so you see, I understand where this question is coming from because let's say, for example, for motor insurance, when you get an insurance, let's say from Jubilee, and you get another one from your UAP, that's double insurance because what an insurance is meant to do is to indemnify, take you back to the level you're at. So if your car was worth 2 million, and then you take an insurance from Jubilee and an insurance from your UAP, and your car gets into an accident, you being paid out 4 million is against the rules and regulations of insurance. But you see, with the life, you cannot really put a value to a life.
Yes.
What can we say your value is at, right? So even if you have life insurance through work, first of all, you have to remember you can't move with it. If you're to move jobs, let's say, for example, like you see now, it's not like a pension. You can actually transfer a pension when you leave work. With a so group life, you only benefit when you are employed. So even right now, if I'm employed, because I've seen many people who don't move, cannot move work even if they have a good opportunity because the new workplace does not offer life insurance. So you can imagine you got into this workplace at the age of 25. Now you're ready for greener pastures, you're 40. Insurance is so expensive at that time. Now you're wondering, should I stay where it is that I'm at because of the benefits, or should I leave? So I always insist, even if you are employed, build your own benefits that you can move with. So things like medical cover, you don't have to get another one if it's already sufficient at work, because most probably when you go to a new workplace, you can still get another one. But life insurance, not everybody offers it, and you can't move with it. Yeah. And so it's always important to have your own, and it will not be double insurance.
Okay, thank you for answering that.
Yeah.
I'll ask
Not
one
multiple covers.
before you continue, because this is a hot topic in the comment section. Somebody asked, is it possible to place an insurance under a trust? And somebody asked a variation of that question is that, what is the difference between life insurance and trust? Like the whole trust
Okay.
is a lot.
Yes. Awesome. Yeah. This is something I do every day. So you have to remember a trust is a legal entity. Yeah. That is meant to, you see now, like just the way, like there's a company, there's a trust. It's a legal entity which has managers, who are called the trustees, and beneficiaries who can benefit from the trust. So you see, a trust is like a human being. It can still own assets. It can manage assets, just like it's like you now moving the power from you to now the ownership from you to the trust. Yeah. So for asset protection, because you know that anything that is under the trust is not going to be compromised and does not go through probate. And yes, you can make the trust a beneficiary of your life insurance. So what that means is, in the case one was to pass away, get incapacitated, the payout will be done into the trust. And because of how you structured your trust, you'll be like, okay, instead of my family receiving 20 million shillings lump sum, I want my family to be receiving 200,000 a month. You can structure it that way. So trust and life insurance are two different things. A life insurance is a financial tool. A trust is a legal tool. Yeah, a legal entity. does think of it like a person, yeah, that owns this thing. So it's very important to have a trust if you can, because it does also help with succession matters. It doesn't go through probate as well. So if you've transferred all the assets you have, you see now all the investments that you're making, you're creating, you can transfer your house to a trust. You can, everything, bonds, everything can now be under the trust.
What's the
So
benefit?
it's like literally you're owning everything. You own nothing, but you control everything. You've taken the ownership from you, so you cannot be liable. Let's say, for example, you were to get sued, for example,
Yeah.
or someone is now like targeting you. But then now when they come to you, you don't own anything because everything has been transferred to the trust. But you see, you can also be a beneficiary of your own trust.
Okay.
Even for people who are single, you can create a trust. You are the sole trustee and the sole beneficiary. It's just that you've transferred ownership. Just
Okay.
like now a company. Yeah.
All right. All right. All right. All right. We
A
did.
very good tool to have. It's good to have both. So most of the people who are getting life insurance through us are also setting up a trust. So that now, like within the trust, now you can actually say, yes, I've taken a 20 million shilling policy, but I don't trust to leave it all to somebody. So I rather put it in the trust, and whoever is taking care of my kids to receive monthly stipend, like a monthly amount of money that I used to provide. You see, like the 12 million shilling example I was giving.
Yes.
So someone can be like, instead of someone receiving the 12 million, maybe the person, even if there's someone who love my kids, they might not know how to manage money. So
Yeah.
rather the trust is managing the money. You like, okay, if I was to pass away, the money goes to a low risk investment. And then it will be dispersing 100,000 every single month to your kids, to the person taking care of your kids. In the case of school fees, you can put it in the trust that an invoice has to be given to the trustee, and the trustee will send the money directly to the school fees, to the school. So it's just how you structure. I've seen how people have done it, and it's like they're still alive. Like just think of a trust as a continuation of you. You
Okay.
don't die.
Okay.
Yeah. So all your wishes have to pour into the trust. So how you structure your trust is very important.
Yeah. So
Yeah.
it's like what I'm hearing you say is like when I pass on, for example, I have children, or even if I have dependents, right? A trust is like me creating the rules about how I want the money to be spent.
Yes, exactly.
Good. Okay.
Yeah.
Okay. You are a host again, Marianne. So please continue with your presentation.
Okay. Awesome. 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 I hope people are learning something.
They are, and many more people are learning. So we will ask them after you're done with your presentation. Thank you, guys.
Awesome. Okay, okay, resume. I don't know. You've made me host. I don't know, it's not resuming.
Yeah, you are.
I am.
Yes.
Let's try again. Okay.
Okay.
Give me a few seconds. I'm waiting for it to load.
Oh, so you're able to share.
Okay, yeah, let me just, oh goodness, sorry. Let me just reload this. I think I removed it prematurely. Let's share again. Let me know if you can see my screen. Can you see? Okay, let me start sharing again. Can you see it now? Okay, okay, awesome. Let me just share it well. Put it under presentation. Okay. It took us way back. Let me just move back to where we were. So we were at whole life. So remember again, term life is for a specific period of time. Yeah, now we are at whole life. So whole life it provides protection for the rest of your life. Guys, for people who, for some reason, are scared of talking about, passing away, I understand the culture around it, religion about it. But the one thing is true, we are all going to go. The cycle of life dictates that one day we are all going to leave this earth. So with our whole life, it provides protection for life. So it means that for sure, this money will be paid out because for sure, everybody is going the same direction. Yeah. So it offers a death benefits to beneficiary when the policy holder passes away, but it also has the living benefits, just like the term life, of critical illness and disability protection. Yeah. So what is whole life best for? Yeah. So remember with the term life, I said it's good for things which have a finite or time, like an actual end time. Yeah. Like let's say like a loan, a mortgage. Like for me, if I'm saving for my kids' education, after a certain age, I'm no longer saving for their education. But what is a whole life best used for? So it's also good for protection because it will still offer protection when your children are still young. Especially, let's still go back to my example. I have the 3-year-old and 4-year-old. In the case life was to happen, at least we know that if it is before they hit the age of 25 and they're still dependent on me, the whole life will pay out and it will still take care of the bills. Yeah. But then after the age of 25, your children might not necessarily really need your income. So anything you leave them at that point is like an inheritance, right? And a good man, we say a good man leaves an inheritance to his children's children. Yeah. You have to ask yourself, are you leaving debt? Are you leaving an inheritance? Are you leaving, your children a stepping stone or a stumbling block? Please point to your heart and ask yourself that question. Yeah, because a lot of people, because of culture, fear, they're going to be a stumbling block. That's why many generations keep on pressing the restart button, just because people have a fear of like, oh my God, I don't want to talk about this, so I'm not going to plan for it. But the thing is that we're all going to that direction. Yeah. So it's important to have it. As I said, protection planning for myself, I have both the term and the whole life. I use term life strictly to protect my investments, especially for my kids' education. And I have whole life to now for the other things, food, clothes, and shelter, if something was to happen to me before they turn the age of 25. And after that, I mean, if anything happens to me after that, I don't mind leaving my kids something. Yeah. So they can use it for a business, they can use it for housing, whatever it is. Yeah. So as I said, for the people who are asking about a trust, they can leave it in the trust and dictate how the children will use that money, so that at least you know that they're not going to squander it. It's all about how it is you choose to structure your portfolio. Number two, as estate equalization. So what does this mean? A lot of people have assets like land as an investment, right? But then maybe someone has land, has houses. So now how do you divide them equally? Or maybe you have a business. So for anybody who's a businessman here and is a legacy thinker, maybe you have a business and you have 2 kids, and you've seen that out of your 2 kids, there's only one of them who's interested in the business. So how do you leave these assets equally? So you can be like, okay, I'll give 100% of the shares to one of my kids. Maybe my company is worth 50 million, and I'll take an equal value of a life insurance of 50 million, so that when I'm not there, this one will get the company and this one will get the cash. You see, so estate equalization is good, especially for people who have like lots and lots of illiquid assets, so that you can subdivide the assets well, yeah, and the investments and everything that you leave. It's very good for distribution. Whole life is good for distribution purposes, yeah. Because as I said, even as you leave your children assets in forms of land, so you want to leave them some cash that they can develop that land. How many people who have been left for a land in Ushago, and until today that land is just there chilling? If they had a bit of money, there's something they could have done with that land. So you can leave your children such prime land, but if there's no cash, they'll have to sell it, or they'll be feeling too guilty to sell it. So it will just chill there and they do nothing. Yeah. And thirdly, wealth transfer. There's some people who take now the whole life, because we know that, as I said, when it comes to overall wealth management, there's the protection, there's the creation, and the last one, which will cover, which is distribution. So a whole life cover is very good for wealth transfer, passing of wealth from one generation to another. Yeah, because I always say that, yes, we pay these premiums. We don't know when it is that we're going to go, but at least we know, even if you're to go in, like, you wanted to leave your children, like, let's say about 20 million, even if God forbid you were to pass away in year 5, at least your children will still get the same that amount of money, that 20 million, because you are paying the premiums. It's because, you see, now the thing is that you have to remember, life insurance comes in because we did not have the time to fulfill and build all the assets we had expected to build, or the wealth it is that we wanted to create. So life insurance comes in as a replacement tool. So this is an example of a whole life cover. Still, as Anne, you remember Anne in the previous example for term life, it was coming to 5,000. You see, for whole life is just a bit more expensive. It's a bit, just you make a bit higher investment, but it's because we are assured this amount of money is going to be paid. So even with this specific policy, yes, you pay the term for 20 years, but even if the 20 years are over, you stop paying for the premiums, but the cover is ongoing until you are no longer here. Yeah. You see, with term life, when the 20 years are over, that's it. It's a wrap. With a whole life, even if the term is over, the policy will continue until you're no longer here. So if you're 30 and God forbid you're to die at 55, this policy will pay out. With a term life, it will not have paid out if you passed away at 55, because you'll have stopped paying at 20. Yeah. So it will still pay out in the case of a severe illness, as mentioned them here. And in the case of accidental death or disability, there'll be an extra 10 million that will be paid out. So you have to remember that in the case, then there's the additional, what they call bonuses. So usually some insurance companies, to cater for inflation, just add a bit of an amount of money, like every 2% of the sum assured every year, to ensure that you're beating inflation. So I always tell people, please try to live as long as you can, because let's say, for example, someone died at year 1, at 2%, that would have been 200,000 times 2. That means the family would have received, the minimum is the 10 million plus the 400,000. But if the the person lives the whole 20 years, it will be the minimum of the 10 million, the family will receive plus 4 million. So a total of 14 million that will leave us an inheritance. Yeah. So you can see that it will have done the protection within the 20 years when the family is so vulnerable. But after 20 years, you don't need this thing anymore to protect your kids, but at least the money will come as an inheritance. So you have to know what to use where. Yeah, this is, yes, a bit like more than the other, with like about 2,000 something, but at the end of the day, we are assured that this amount will be paid out. Then there's the endowment and education policies, which most of you now are conversant with, because actually the reason why there's a lot of beef between the clientele and people in general and insurance policies is mostly because people don't understand how these ones work. So you have to remember, an endowment policy is a life insurance with a savings element. So it offers a death benefit to beneficiaries if the policyholder passes away or gets a critical illness or disability, depending on the policy you have, or it pays out at maturity upon survival. This is because it's a savings plan. It's a life insurance product with a savings plan. So please, for just moving forward, just remember, this is not meant to grow your money. Just think about savings. Savings does not grow money per se. You're just putting money over a period of time, just like literally for you to just see that it's there. You're literally putting it in a savings pot. That's why you can see the return on investment, or like when you look at an endowment policy from a return in investment lens, you will see that there's no money, like you didn't make that much money, maybe just a bit more, right? And remember, there's different types of endowment policies or education policies. Others give a better return than others, and others are just outrightly bad. Yeah. So you have to be very careful on how it is that you're buying, unless now your mindset when you're buying this thing, you're like, okay, at least it's something. Yeah. But I would believe that if you're making a plan or you're making a financial decision, let it be optimal. So if you're going to, let's say, for example, go down that direction, at least pick the best of what is there. Don't buy just because you are pressured by the agent. But also it will be important to be like, okay, what is the goal? To plan for my children's education. Is there an alternative way of planning for my children's education? And then you explore, like, okay, which one is best for me? Because there's some people, if they didn't have an education policy, at the end, they'll even have zero because of their absolute lack of discipline. So I always say lack of discipline will cost you either way, with low returns or absolutely no returns. So if you were to be like, okay, I'll save through my children's education with a money market and a term life policy, right? Because the term life will do the protection and the money market at least to grow the money. But if you didn't save the money in the money market or you ate that money, so it means your children will have no education. So it means then it's a you problem. But now, let's say, for example, now if you're to do it with an education policy, yes, the return will not be that much, but then now for someone who's not disciplined, it's at least it's something, yeah. But it's also important to understand how these things work. This one is not a pure, the first two I mentioned are pure life policies. That means that they're pure risk products. Endowment has an element of savings to it. So it's part of your, whatever you're contributing goes towards an insurance, part of it goes towards a saving. That's why you don't get the best, I mean, like, let's say, for example, return, if we were to look at returns, and you also don't get the best insurance, because it's like, I always give the example of trying to use a saw as a hammer, or trying to use a saw and a hammer together. Like you're told you're going to buy a 2-in-1. So an endowment policy is like a 2-in-1. So it's like using a saw, which is also a hammer. Yeah, it might not be the best tool for whatever it is that you're trying to do. So it's good to be like, okay, do I want to protect? What do I use? Do I want to save up? What do I use? And if you choose to move forward with this, you understand the repercussions, you understand everything, the in and out. And please always remember, you have a 30-day window time, 30-day window period where you can look at your policy document. And if whatever it is that is written there is not in line with what maybe the agent promised you or what you thought you were buying, you can always cancel the policy and your money can be returned. So always insist to get your policy documents. So these ones are usually mostly used for education planning and disciplined savings. So if you're disciplined and you want to grow your money, there's definitely better ways of now trying to save and invest. And if you're looking for education plan, I've spoken with Agatha with this. I'll ask her to just share with you the link on the video it is that we did, so that now we don't have to talk about it here again. Yeah. So it's always important to understand the pros, the cons before you even move forward. Unit linked policy is also kind of similar, but not really. So you remember the other one is a savings plan, a life insurance with a savings plan. Unit linked policy is what do you call it? Is a hybrid financial product that combines element of insurance and investment. So just think of it like you've bought your own term life policy plus unit trusts. Yeah, unit trusts are usually like now the equity funds or debt fund, which is now like the bond fund, so, or a balance fund. So this is now you just doing it under an insurance policy. So you can easily just buy your own insurance and invest by yourself, but it's all up to you. So these ones are extremely high risk. This one, the money is not guaranteed. So for the other one, for endowment, usually the money is guaranteed, yeah, because it's a savings plan, just like a money market, yeah. The money there's guaranteed, the return could be low, but at least you know that you're going to get a certain amount. Whatever it is that is stated in your policy has been guaranteed. With this one, because the money is being put in higher risk investments like equity, you might lose even all your money. Yeah. Now it's up to you now to figure out, okay, if I'm doing this, why am I doing it? And is it advantageous for me to just do my investment separately? So that's why I put it here. It's like now part of your premium, let's say you're putting 10,000 per month, maybe like a good 1,000 bob goes towards a life insurance premium, and the rest goes towards now putting money in the debt fund or equity fund or a combination. Yeah, for you to reach whatever goal it is that you want to reach. So please, for such type of policies, the ones which are like a combination of things, be very careful, because most people don't read the terms and the conditions. And most people buy these life policies because of tax benefits, but please, may that not be the main reason why you are getting a policy. Just remember, the policy is meant to protect. Yeah, tax benefits are still there, but let it not be, I'm buying this policy because of the tax benefits. When you do the calculations, you can see that, by the way, I could actually have made so much money even compared to the taxes I was saving. Yeah. So always do the comparison. And then we have now, lastly, the funeral or last expense insurance. This one now comes through. It's a type of insurance designed to cover the costs associated with a person's funeral, burial, or other related expenses. So we know that, as I said, people pass away, whether it's relatives, doesn't matter. So this one, it's provides an amount of money, usually within 2 days of someone passing away, and giving the insurer like the burial permit, so that you can get the money to be able to, like say your goodbyes with dignity. So many people who usually have these covers don't have to go too much towards now, like maybe contributions towards a funeral, because this one already pays out. So you ask yourself, okay, in the case of now, either it's you can take for yourself, or even for you and your family, or even extended family, so that if anybody was to pass away, at least you know that an amount of money is going to be released to remove the burden of having to now look for well-wishers. Yeah. So it's a good cover to have, especially as groups, because we know someone is going to go. We just don't know who, how, and when. Yeah. So we just be like, okay, if it's a grandparent, an auntie, we know for sure at least that amount of money will be paid out. And now it will really remove the burden of now having to contribute. Yeah. So what are the factors affecting the cost of our life insurance cover? So number one, we have age. So obviously, the older you are, the more expensive it is. So that's why we always say it's good to get this life insurance as early as possible. And also remember, age comes with its own level of complications, maybe in illnesses. Remember when you lock down this life insurance when you're young and healthy, even in 10 years and you have like high blood pressure, the insurer cannot say, right now we are not covered because you've contracted this illness. So it's good to start as young as possible and lock down the amount of money. Yeah. And then secondly, we have smoking status. When you are a smoker, so smoker means that you smoke a cigarette, you vape, you chew tobacco products, yeah, that is, or you smoke shisha. So smoking usually is seen as high risk. So the premiums are a bit higher for people who are smokers, yeah. Gender, women live longer than women, so women's premiums are a bit cheaper compared to men. Type of cover, you see, like a term life insurance is cheaper than a whole life. Yeah. So when you are picking these covers, type of cover affects the cost. Policy term, depending on how long you're going to take a policy for, it does also affect the premium. Occupation and hobbies. If you are a rider, you ride bikes, because of the high risk that you face, insurers are going to charge you a bit more. So if you're a skydiver, you better be declaring these things, because it will affect the cost of your premium. Payment frequency. So some insurers do give a discount in the case you pay as a lump sum, right? And policy riders and features. So if you're to just take a life cover by itself, it's going to be much cheaper compared to if you add on like critical illness cover, disability covers. Those are now like extras. Yeah. So those actually affect the cost of life cover. So what are the riders? Riders, as I mentioned, are the extra benefits on a life cover. So this include number one, critical illness cover, so that now you can also have a living benefit. So someone does not only have to die to be able to access the life cover. So critical illness is a lump sum that pays out upon a diagnosis of a cancer, stroke, kidney failure, all the things that are listed. Yeah. Then permanent disability cover. So in the case someone also was to get a disability, whether through an illness or an accident, a lump sum payout is, oh, sorry, I've put here, it's not meant to be this, it's paid out in the case of the disability. Yeah. Accidental death protection. Usually if someone passes away due to an accident, it's usually paid double. Let's say someone had taken a 10 million shilling policy, it will pay out double, because accidents are completely unforeseen. So usually if you buy this as a rider, it pays double. Waiver of premium, in what I'd mentioned earlier, in the case someone was to pass away, or let's say, for example, someone was to be diagnosed with a cancer, if they have a waiver of premium, they do not have to continue paying the premiums anymore, but the life cover is still ongoing. There's some covers which also have retrenchment protection. In the case you're to get retrenched, you lose your job, it gives you like a window period where you don't have to pay for the policy, but you're still on cover. So what are the myths around life cover? So most people think that, okay, life cover calls death. I don't think I need to explain that much. There's so many people in this country or just worldwide who've passed away without even having a life cover, and so many who had a life cover and are still alive. Yeah. So I think it's just a misconception, and maybe due to cultural reason, people think this. People think that life insurance is extremely expensive, which is not, it's not true. Expensive, I think, is also relative, but you've seen based on the example for a 10 million shilling cover can be either 5,000 or 8,000, depending on the insurer, right? So what other myth? It's for old people. That is also not true. Who are about to die. That is not true. Life, anybody could pass away at any time. Anybody could literally get a critical illness at any time. We've seen people getting critical illness, heart attacks, cancers, even in their 30s. So it's always important to have one, even when you are young. First of all, to lock it because you have good health. So that's, I don't know if there's any other myths that you've had, but you can always put it in the comment and I will demystify. So life cover for different stages in life. So most people are like, oh, I am single, no kids. Do I need a life cover? So you see, life cover is important, not just for the death. So if number one, someone depends on you, it doesn't matter whether you have kids or not. If your family, your parents depend on you, you have even a business that depends on you, that in the case now you're to pass away, it will really affect, or a partnership, you will need to have life cover. And life cover, not just also for the death benefit, but also for the living benefit. Even as a single person, you can get a critical illness. You'll need an income replacement. You can get a disability, you'll need an income replacement. So it will be important. If you're married and have kids or someone who depends on you, please, this one is even a no-brainer, no question. Yeah, you have to, because as long as someone is depending on your income, it is so important for you to have this cover to replace your income in the case of a death, disability, or critical illness. As you're heading towards retirement, the need for life cover reduces, most probably because your children maybe are much older. But nowadays, people are getting married later in life or getting children later in life. So as I said, all cases are different. So if you're, let's say, for example, you're a 50-year-old, and I had a client who was 50 and he got a baby unexpectedly. Yeah, he was planning for retirement. Then his wife fell 6. So you can imagine that now how that affected now his life. He had to get a life cover because now this child is a newborn. He has to actually take care of him no matter what, right? So this one, it depends, right? Because people have different backgrounds, different situations. People are going through, maybe they've been divorced, they're single parents. So depending on where it is that what stage you're in life, it will be important to have like a one-on-one conversation to see. So why do most people not take life insurance? Mostly because of cultural and religious reasons. Based on my research, most people have a fear of even thinking about what could go wrong. But I always say it's one of those things that it's very important for you to definitely think about, especially when you have a family, because ignoring something does not mean that it will go away. Just because someone did not take a life cover does not mean that if they are no longer here, there'll be automatically someone who takes care of your family. Like some people who passed away during COVID, people who are losing jobs. So even if you are depending on a relative, yeah, maybe they're also like trying to figure things out. That's not the time now to now wonder, like, okay, my spouse was contributing 100,000. Yeah, where am I? Will your friends, you have to ask yourself, can your friends comfortably raise 100,000 in the case your spouse were to pass away, or you're to pass away and you have kids? So if you know, not really, yeah, it will be important to make sure that you have a life cover. As I said, let your friends show up for you in different ways. They can be there for you spiritually, hold your hands, or no matter what. But now when it comes to finances, they also have their own family members there. And the worst thing that I see is, because most people don't plan for their kids, children end up being bounced from one household to another, which creates another layer of trauma, right? So another thing most people want to know is the claims process. In the case of a life cover, if someone passes away, all you need to do is just call your agent or the insurance company, fill in the life insurance claim form, give out now the required documents like the death certificate, the ID, and if it's a beneficiary, they have to give their bank details. And then within 14 days, usually it's processed. Yeah, especially if it's a natural death. Yeah. And critical illness disability, the same thing. Yeah. This is why usually when you're filling in your insurance forms, they ask you for your bank details. Yeah. So critical illness, if you are to be diagnosed, the insurer will just ask for a doctor's report. And sometimes they can ask for you to go to their own doctor as well, just to make sure that actually that is the situation, because there's also a lot of fraud in the country. So that now, like, okay, if they're like, okay, you have this illness, just fill in this claim form, and it doesn't take long. And why can a claim be rejected? A claim can be rejected if you lied at the beginning. If you, let's say, for example, you said you are a non-smoker and you are a smoker, the claim can be, or if someone died because they were a criminal, so there's different reasons claims can be rejected. But that's why it's important to also have the right advisor to walk you through, because the advisors will tell you, you can lie so that now the premium is less. But let me tell you, if there's people who know how to check whether you are a smoker or not, or whether something like let's say, for example, yes, you started out as a non-smoker and then you smoke in between, please just let the insurer know, because the premium that they've given you are based on non-smoking rates. But if you are like, now things change, let's say, for example, you came in when you are okay and then you got sick, that is not necessary. But now there's some fundamentals at the very beginning, you have to be very, very honest. And then in order of priority, what do you start? I know this is where most people are like, okay, I have limited funds. What do I start with? So usually, so as we had mentioned, like the wealth management is made out of three main stages: protection, accumulation, distribution, or transfer. So you have to build your wealth plan from the ground up. Yeah. You have to ensure that you have a very solid foundation, so that even when life happens at the top there, you don't have to ever start from scratch. This is why you have to ensure that, okay, first of all, you are saving towards, yes, an emergency fund. You have a health insurance, even if it's NHIF, and a life cover. We've seen you can even get a life cover for 1,000, 2,000 shillings. Just in the case now you don't know how to distribute your funds, you can come to us and we can guide you on the same. You're like, okay, I have 50K. Yeah. I have all these things that I need to plan for. Where do I start? But always remember, when you're building your wealth plan from the ground up, it's important to start with protection. Just the way I'm sure Agatha tells you, don't start planning for long-term investments if you don't have an emergency fund. That moment your money is stuck in land and you can't even access it. So it's important to have your emergency fund. And remember, because there's some emergencies which even an emergency fund cannot take care of, this is where now the insurance covers come in. You see now, like things like life, disability, critical illness, this is just one policy. You can just buy it under one policy. Yeah. Then the health cover, make sure you have an HIF at least, and private medical, at least inpatient. A will, it can either be in both protection and distribution, because a will is so important so that it can say, oh, okay, in the case I was not there, this person can be guardian. In case I was not there, these are the things that I have, and this is how I want it to be transferred. But yeah, when we have that conversation, because we also do help families with wealth distribution. So if you want to have the will conversation, the trust conversation, we can also guide you in that, yeah? And then this is the wealth accumulation stage, where now this is Agatha's now area of specialty. So it's always important to make sure that, okay, I have put my protection plan in place. So just the way we're like, okay, at least reach your 6 months worth of expenses and at least a medical cover. And then you can start investing, so that you know that even if life is to happen, you don't have to go back to your investment, as I said, to service negativity, please, because you already put aside a fund and a protection portfolio to take care of that. Let these investments to continue growing without having to touch, in the case of unforeseen, because unforeseen things, it happens. And nobody ever plans to get sick. Nobody plans to get a disability. Nobody plans that someone will pass away in the family, but it does happen. So it's important to make sure that you're doing all of them concurrently. But if you're to start with order of priority, start with the foundation, the wealth protection. And then when you reach a certain level, which we can guide you, we can be like, okay, now you are ready to start investing. Yeah. And you can even now invest even aggressively because you have a protection plan. Let me even tell you the reason why I personally, where I'm at, yeah, remember I'm a businesswoman, but I also invest a lot. The reason why I invest with so much peace of mind is because I know no matter what, I have my emergency fund. Even if I didn't have an income for the next 6 months to 8 months, my children and I can still survive. I can still pay their school fees, and I can go back and restructure. In the case life was to happen to me, I have a life cover and I have disability critical illness cover. So I can even go higher up because my foundation is strong. Just think about it. For a house to go very high up, you have to have a deep foundation. So make sure your protection plan is so solid so that even as you go up and up, you don't have any fear of liquidity risk. Yeah. So just make sure that you build a very strong protection plan. Yeah. So let me show you how most financial pyramids look like. Most of them look like this, upside down triangle. So the protection is extremely low. But now, because most people love property, love like forex, speculative investments, you'll find someone who has put money in crypto but don't even have an emergency fund. Yeah, they don't even have any insurance. So most people's protection, wealth pyramids look like this. So if life happens, so unfavorable market conditions like what has been happening the last few years, or critical illness, death of a breadwinner, what happens? It crashes because it was not stable. You didn't start from the ground up. You put so much energy and time into now like the illiquid investments, and then no money, or you've not put any plan towards your protection, and then everything comes crumbling. You've literally seen people having to start afresh. The reason why you have a protection plan is you don't have to start from scratch. Your family does not have to start from scratch. I always say a protection portfolio turns a mountain into a molehill. Yeah, because what would have been so big and as a headache has been reduced because you have a plan. Yeah. So this is what happens. You see, this is your insurance portfolio, which is usually the health insurance, life insurance, disability, critical illness. Emergency fund is part of protection portfolio. It protects your wealth. Then we have your investment portfolio, the shares, the real estate, the bonds, commodities, forex, crypto. This is meant to grow your wealth. Don't interchange. Don't use a protection tool for an investment. Don't use an investment tool for protection. Don't say I'm going to use the what do you call this? Cash flow from my real estate investment as a protection. Yeah. Sometimes we're not even assured that at that time when the unforeseen circumstance happen, you still have that cash flow. So it's just good to just put everything in its own box. Yeah. And then the case study, I've given myself as an example throughout. Yeah. Even when I was starting out, I made sure that, first of all, because I have 2 young kids, life insurance was a no-brainer. So I have both a whole life and a term life. As I said, term life is literally to protect my children's education fund for the period of 16 years that I'm putting this aside. I'm putting aside, like the premium is like around the 4,000, and I'm okay with it, putting that amount of money aside. And I know that I will not get that money back when I survive the term, but I'm okay. But I'm like, if life is to happen, at least I know that 4,000 shillings per month will come through. And then I have the whole life as well, so that now it can take care of now the other things like food, clothes, shelter in the case I was not there. And if I was to not to be there, I was to pass away before my children hit 25. But after 25, when they are able to take care of themselves, that amount of money will go in as an inheritance. I mean, I'll leave my kids as stepping stone, or I can even put it down for my grandchildren. Yeah. Even with regards to just overall protection portfolio, I have my medical insurance. So for me, I had to get an outpatient cover because my kids go to hospital quite often. But before, I had just started with just an inpatient. But eventually I was like, okay, it cost me more to do this thing of pocket. So let me just buy also an outpatient. Same thing, I have an emergency fund, as in when it comes to my protection portfolio, I have them all. I currently have a will, but I'm in the process of setting up a trust. I have whole life, I have term life, I have my now like the emergency fund, just to know that, okay, now as I'm investing, as I'm building my business, as I'm putting money into my business, I'm putting money into investments, the fundamentals have been taken care of. No matter what, I do it with such a peace of mind, knowing that my kids are okay no matter what. And even if life was to happen, you can go through that with from a place of dignity. Yeah. So there's the frequently asked questions, which I'm going to answer, then I'll answer any questions that you may have. Can one take, and by the way, if you want to sign up for a life cover, Agatha can send you the form for you to fill it in, just in case. And then number 1, can one take cover jointly with a spouse? The answer is yes. So what happens is that now you'll have a joint policy, But usually the risk of this, based also in my own experience, I had a joint cover with my husband and he passed away. And so when he passed away, the policy ends. Yes, there's a period that is done, the policy ends. Now I have to buy a new policy for myself. So it means I'm a bit older. So I always advise, if you can, just do it separately. Or sometimes when people go through a divorce, separating a life cover is a struggle. Yeah, it always gets extremely dramatic. So I always say, just for you to get the best level of protection when it comes to life, it comes to critical illness, disability, it's good to have separate covers, but you can choose. It's all up to you and what your family goals are like. Yeah. I always say you can take a joint cover if you have maybe a joint mortgage, or you have a joint loan or joint something to protect the specific thing. Yeah. What's the difference between medical cover and critical illness cover? Medical cover pays hospital bills, so the money does not come to you, it goes to the hospital. Critical illness cover pays a lump sum to you to replace your income. Medical bills pays the hospital, critical illness cover pays you. I'm single, no kids, never planning to have kids. Do I need a life cover? The answer is it depends. Yeah. Because I get so most people who are single, no kids, never planning, and do not even have anybody who depends on them, some of them just take a standalone critical illness and disability cover. So they're like, if they're to pass away, nobody really depends on them. Yeah. But if you have someone who depends on you, whether it's your nephews, your nieces, even if you don't have kids, never planning, but they actually depend on your income and they're going to suffer in the case you are not there, please just get a life cover. Or you could also change your mind. There's also that. Yeah. So I have an endowment policy that's not making sense. How do I opt out? Hey, this one to get out is usually a bit harder. So let me give you an example. If you've been just there for less than 30 days, and the policy is not making sense, you can get out and get your money back, at least that first premium. Yeah. If it's been less than 3 years, more than 1 month and less than 3 years, if you try to pull out, you can lose all your money. So it depends. If it's so bad, before you move out, please consult a specialist so they can tell you, okay, how to go about it. So maybe what you could do is structure it downwards. Maybe pay the minimum that you can. Maybe you can be like, okay, the minimum for the company is 2,000. So you'll be like, okay, so that I don't lose maybe all the the money has gone, sinking like the sinking ship phenomenon. They're like, okay, it's gone, it's okay. Yeah. So it's up to you. And also now, please don't cancel without an advisor. If it's almost maturity, just let it be. Just don't cancel it. And for some people, if instead of surrendering, you can change it to what we call paid up policy. So you don't surrender it, you just stop contributing, but you'll still receive a bit of money upon maturity. So we do guide you in the case you need that help here. You can just let us know so that now we can see for your specific situation, what is the best for you, so that we don't say, okay, cancel. And then now you end up having absolutely no cover. You still have a 6-month maybe waiting period for the new cover. So just use an expert here. What happens when I lose my job and can no longer pay for the premium? So for this, I always say, people, please include the life insurance premiums in your in your emergency fund. So if you pay 5,000 per month, please just include it. Be like, okay, if I was to lose a job, at least I am sure that I can still continue paying for this for at least temporarily as I'm looking for another job. Secondly, you can say, okay, I have put my money in a bond. The coupons or the interest from this bond can be used to pay my premium. So you can use your investments to pay your premium. So it's good to plan even before you lose your job, to be like, okay, what is the risk strategy around this? And thirdly, you can reduce, as I mentioned, you can reduce the premium to like the very, very minimum. And please always inform your insurer. Just don't stop, because again, remember, you've put this money for a very long period of time. The life insurance is a very long-term policy. That's why you have to get it right from the beginning. Agatha always says, you don't end wrong, you start wrong. Yeah. So just make sure that you get the right product from the very beginning. Ask a lot of questions. If someone doesn't want to ask your question, go get another agent until you are completely satisfied. What's the tax advantage of a life cover? there's a tax relief of 15% of your annual premium to a maximum of 60,000 a year. So if you're paying a premium of, say, about 10,000 a month, 15% of that is 1,500. So you can actually get tax relief of 1,500 every month times 12. That's about, I think, 18,000 a year. Yeah. So that marks the end of my presentation. And please remember that both wealth creation and wealth protection are equally as important. In order of priority, please start with your protection so that even as you're getting into your wealth creation journey, you can do it with a peace of mind, knowing that, hey, every asset that I'm trying to build here is protected. So even if life happens, I don't have to start from scratch. So always start from the beginning. Yeah. And you can do both of them concurrently. You can be paying your premiums and also investing at the same time. And if you want like now something just for you, you can always just reach out to us and we can guide you on the same so that I'm like, okay, this is the amount of money I have. This is how it is that we're going to move forward. So thank you for being with us and thank you for bearing with us this whole time. I know we've taken quite a bit of time, but I really, really hope that you're able to get something out of this. And yeah, I'm ready for your questions.
Okay.
Thank you. Yeah.
So much, Marianne, for educating
You're
us.
welcome.
We appreciate it. I've learned a few things myself. I'll mention just three. Just because you ignore it doesn't mean it will go away. Just because you ignore it doesn't mean it will go away. And this this is about your health, critical illness, an accident, life insurance, especially if you're a parent. For me, when I hear this life insurance thing, I worry for parents because especially there's one more thing Marianne mentioned is that one of the worst things that your kids can ever experience is being moved from one home to another. You know, we all have those bad aunties and bad uncles in our family. When unajua somebody
I know.
but you know very well that they will never
very well that we will never. Exactly.
So don't do that to your children. And then another situation is that don't sit there and
don't
I wonder why there's an echo. Don't sit there and have and liquidate. Don't sit there and accumulate unproductive land in the name of I am building wealth for my children. Remember, there's somebody I had say, and this was Amanda.
This was Amanda.
He said that what happens most of the time is that as a parent, when you pass on and all you have is those assets, mashamba, and apartments, and you have no liquidity, there's no cash flow.
Yeah.
Your children will sell those plots of land in order to get liquid.
So yeah, they'll have to.
They will have to
Cash is king. Cash is king. You can't go to the shop and say I have prime property in Karen. They'll be like, show me the money.
So remember that we are recording this webinar. So we will YouTube. Yes, and Marianne, because on my end, please check the questions in the chat box and answer them from there because my echo might make this last longer. Also, please take maximum 15 minutes to wrap this up. We've been here for longer than expected and you don't have to keep
I know.
short
It's almost
answers.
10. Wow.
Yeah.
Yes. So number one, someone has asked, how is the payout received if the child is under 18? So if the child is under 18, you have to place a guardian. You have to, like, even in the application form, there's a place where you're going to put a guardian. So what usually happens is if you pass away before your children are 18, the guardian will be given the money. I think this is why most people are actually pretty scared of leaving maybe a guardian with a good 20 million, 30 million. So this is why, especially when you have young children, set up a trust and let the insurance be paid into the trust. It's rather even the guardian receives like the 100,000 per month compared to a lump sum maybe they've never received. Because what we see is people receive a lump sum, then they're like, hey, I'm going to start a business and pay it back. Then the business doesn't work out and your children's inheritance and protection is gone. So yes, the money is paid out to whoever it is that you've placed as a guardian. Yeah. And yes, someone has asked, you can still say, okay, I want this child to get 50%, 50%. There's actually provision for how you want to distribute your life cover. Yeah. What else? I stopped paying because most hospitals pay one civil servant if you went one. Yeah.
Let me ask you, Marianne.
Yes.
Can you?
Yeah.
What do you mean by natural death? What did you mean by natural death?
Okay, natural death means an illness or old age.
Okay, dying
So
naturally.
not an accident. Yeah, not an accident. Yeah.
Okay. Is there a life insurance that compounds and
That
out
compounds and
years?
out
I can't hear you.
I don't know. Is there a life insurance that compounds and pays out at different years?
out at different years.
And pays out at different years. Those are now like maybe the endowment or education policies, the ones which have a savings element. So yes, there's life insurances that do that.
And then I'm looking. I've seen. So somebody made a comment.
I've seen somebody made a comment.
Echo. I don't understand why. So maybe you
Echo. I don't understand why.
Yeah, no worries. Yeah, it's okay.
the chat box if there are any other questions you want to address, and then we close.
Oh, okay. Let me see. Or let me just look. Okay, you have there's one you've already mentioned. Okay, you want a will or a trust. Okay. Okay. Mostly comments. Can you take a group life cover for you and your family? The answer is yes, and it's actually advisable to take the last expense for you and your family. And then what happens when the grace period expires and you're still jobless and unable to contribute? Do you lose your money? The answer is yes. Yeah, like unless now you come back and reinstate your policy. Yeah. So that's why I say it's important that you have maybe, I always say like the best way is to have like an investment that pays for it so that you don't have to think about it on how it is that you're actually going to be paying for this premium. Yeah. Maybe when you're starting out, you can pay from your income, but eventually you can now have the investment pay for it, whether it's your bond or even your SACCO dividends. Regarding the calculation of life cover sum assured, what if I already have a personal whole life cover for a few years, and my income or net worth has increased significantly? Am I underinsured? Can I adjust or modify my existing cover too? The answer is yes. So because things do happen. People change, like your income can change. Let's say now I started and I took a policy when I was earning 100,000 a month. Now I'm earning 800,000 a month. So if I'm still using maybe the 12 million shilling policy, I'm definitely extremely underinsured. So it will be good for me to now update my policy. So you can always take another policy. Because you see now when you're also filling up the forms, there's what we call the financial questionnaire. Like let's say, for example, I'm earning 100,000. I can't take 100 million shilling cover. How can I justify? In as much as I say, yes, life is priceless, but they'll look at, okay, what is your income? What are we actually trying to replace just in case something was to happen to you? So they'll usually use those MATU calculations. That's why they always tell you, put down your assets, put down your liabilities. So guys, don't feel bad or uncomfortable giving this information to the insurer. It's good for them to calculate what is the level of coverage that is important. Yeah. Because now if you ask for 100 million and you only earn 100,000, they'll be like, someone is trying to play games here. Yeah. What is this? I hope I answered Greg. Time was worth it. I think financial advisors out there are not patient enough to explain most of these things to clients, hence the conflict that occurs. That is very, very true. Actually, that's why you have to be very careful. Interview your agents. You're not forced to, because most Kenyans actually, I realized, they just choose it because they feel bad and because someone has bothered them so much. So you just want to get someone off your back. But that's not a good reason. Or sometimes you do it to support a friend. You have to ask yourself, if this person is no longer my friend, can this policy still hold water? Or if this person stopped bothering me and I bought this thing, yeah? Because remember, you're the one who's putting this money towards it. One day, this person is working for UAP, tomorrow they're in Jubilee. You're trying to call them. They're not responding. They're like, hey, me, I can't help you. So please, just remember, this is an agreement between you and the insurer, okay?
Yeah.
Yes.
Is there a way or a way to compare various insurance companies or covers or offers?
Is there a what? A tool?
A tool to compare. insurance companies or covers?
So if you want to compare different covers, you can just tell now maybe your agent to do like a comparison analysis. But for us now at Le Risk, we've already done the comparisons across the market. That's why we pick specific companies we work with. We know who we'll work with for standalone critical illness, who we're working with for whole life, who we're working with for term life. Because sometimes it can be so confusing. So for us, the how we decided to go about it is just to be like, okay, we are going to scout the market and just choose the ones it is that are the one like have a very good claim settlement ratio. We have a good relationship with customer service. When you actually call them, they pick up. So because most people look at it based on price, but that is not good enough. You can look at it based on price. When you come to make a claim, people are like, I can't help you. Or they take you around in circles. Even for me as an agent, it's a lot of work for me to now like start walking around. Even for me, I want to make my life easy. In the case now life was to happen. When life is to happen, that's not the time now to start fighting with insurance companies. So look for a claim settlement ratio of 99 plus, please, for the companies, because you know for sure they're going to pay. That 1% is maybe because someone lied or someone, they were not very straight when they were filling in the forms, or there was just a bit of hiccups. But otherwise, insurance companies, if you do everything right, they cannot not pay you. They have to pay you. Because that's another fear, that I've done all this and people don't pay. They'll have to pay. If you choose the right insurer and with a good reputation, they'll have to pay.
Okay, all right. It's 10 minutes to 10 p.m. We were not meant to be here for this long, so we have to close. Yeah. We have a record.
We have a
We have a recording of this webinar. We'll upload it on YouTube. 2, if you'd like Marianne to answer your questions, to give you a quote, to give you a comparison, to tell you if the insurance all that's
bad.
please fill the questionnaire. The link is in the description. Thank you, Marianne.
Thank you, Major.
Thank you. Thank you so much. And then, Agatha, remember to send them the link to the book as well, so that now they can at least now be able to go through it, whatever it is we've spoken about now through the ebook.
Yes,
Yeah.
I have all your emails. If you joined this webinar, I have your email. I will email you the ebook, the calculator, and the recording. Thank you so much.
Yes. Thank you.
Thank you for being with us. I know our tech issues were many, but asanteni sana for joining us, for being patient. And we will see you in the next